Hello everyone, thank you very much for joining us once again and welcome back. As just we're discussing today deferred tax in the UAE, and in our previous webinars we have already discussed so many things. Even we have already discussed deferred tax assets and deferred tax liabilities. Whatever we are going to discuss today, we are discussing today specifically our focus will be deferred tax, keeping in view the requirement of the UAE Corporate Tax Law. But we'll go through the previous sessions as well. It will be just a refresher, then we'll be focusing on the, as I mentioned, on the key areas. What will the impact of deferred tax, keeping in view the requirement of the UAE Corporate Tax Law? Deferred tax, as we discussed, basically accounting profits are different from the taxable profits. We have already established this. And these differences in between the accounting profit and taxable profit, it can be a two types of differences. It can be a permanent nature differences or it can be a temporary nature differences. If these are the permanent nature differences in between the accounting profits and taxable profit, it will have an impact in one tax period. It will not have any impact in the subsequent tax period, and it will not generate any deferred tax. And the examples are dividend, capital gains, fines and penalties, exempting from 50% of the entertainment expenses. These are the items that will generate the permanent nature to differences. It will have impact in one tax period. It will not have any impact in the subsequent tax period. Now coming back to the temporary differences. The temporary differences are the differences which will have impact in the current tax period. It will have impact in the subsequent tax period as well. Because the basis, the provisions that are being applied to calculate the accounting profit, those are the different from the basis and provision that are being applied to calculate the taxable profits. Since the bases are different, so my accounting profit will be different from the taxable profit. These are the temporary differences. Over the period of time, impact will be same, but timing differences are there. So these will have an impact in multiple tax period. So these temporary differences can be of two types. It can be a deductible temporary differences or it can be a taxable temporary differences. If these are the deductible temporary differences where my taxable profit will be higher by accounting profits, in the current period, we will be paying higher tax, but in the future, we will be given a tax benefits. This is the reason what we call deductible temporary differences, and we are booking the deferred tax asset on this today. If my taxable profits are lower today, means we will be paying lesser tax today. We will be liable to pay more tax in the future. We will be booking deferred tax liability. These are called my taxable temporary differences. We have already established in our previous lectures. We have gone through the examples as well. The permanent nature of differences. Here the fine was the difference. Here the fine, the value of the fine was 50,000 dirham. 50,000 was the fine. Once the fine was, so either the fine was the 50,000, 50,000 was the fine. We said this is the permanent nature of differences. This permanent object have reduced my taxable, increased my taxable profits. But we have not booked the deferred tax. The reason is because this difference was a permanent nature, so it will not have any impact on the deferred tax. You can see into this transaction entry that we have passed deferred tax expense debit. We are debited the tax expense and credited the tax payable, means we have not booked the deferred tax. This difference was temporary difference. Is this temporary difference? We discuss two possibilities. One possibility is when my taxable income is higher. If my taxable income is if my taxable income is higher, then my taxable profits will be higher today. I will be liable to pay more tax. It will be vice versa. If my taxable income is lower, so it will lead to lower taxable profit today. We need to pay more taxable profits in the future, more taxable profits in the future. So this was the basically situation. There are two possibilities. Either your taxable income is low or your taxable expenses are higher. Both of the cases, it will lead to less taxable profits today and less tax today, more tax in the future. In this example, tax depreciation was higher from the accounting depreciation. Due to this, my taxable income was lower. Since my taxable income was lower today, means we are paying lesser tax today, will be liable to pay more tax tomorrow. So I booked a deferred tax liability. This is the entry that we have passed: tax expense, tax payable, and deferred tax liability. The second possibility was that the deductible temporal differences, in the deductible temporal differences, we are paying more tax today, lesser tax tomorrow. So here you can see that here my taxable profits are higher as compared to my accounting profits. Once my taxable profits are higher, means we'll be liable to pay more tax today, and tomorrow we'll be paying lesser tax. Tomorrow we'll be getting some certain benefits. So we booked it as a deferred tax asset. Here you can go through the entry. You can go through the impacts here if you are looking into this. These are the temporary nature. Impact in this period, it has been reversed in the next period. Here we are booking deferred tax liability. This is being reversed in the next tax period. So impact is basically compensated at the end. So whatever the impact on overall period impact is same, but one period impact is different. Next period, individual period impact will be different, but on overall basis impact will be same. And same you can notice here as well. Here we have booked a deferred tax asset that has been reversed in our next year. So overall impact is same. This was just that was whatever we have discussed. This was just a very plain and common wording. The plain and common wording, basically we have taken, okay, we said, okay, if my taxable profits are higher, we are paying higher tax today, lesser tax tomorrow. Since with benefits tomorrow, we need to book the deferred tax asset. In the same way, we need to book deferred tax liabilities as well. We discussed, if we are paying less tax today, tomorrow we need to book the more taxes, we need to book a deferred tax liability. These are just a very plain and common wording. Now what the IAS 12 says, IAS 12 says the same thing but in a different way. How they said? They said basically you need to look into the carrying amount and tax base of any item. Carrying amount, what is the carrying amount? Carrying amount is the amount ascertained by the tax accounting authority to any item. This is my carrying account. Tax base means the value assigned by the tax authorities. So here, as per the IAS 12 says you need to go to the all balance sheet items. Once you are going through the balance sheet items, you need to compare the carrying amount and tax base. And based upon the carrying amount and tax base, you need to look into is this asset or is this liability? So if we are going through the balance sheet items, we can find generally three different types of items. First items are no difference item. Like both of the tax accounting authorities and tax authorities, both of the authorities agree that the base is same. Accounting base, tax base same, like cash. Tax authority says what is the value of the cash. Accounting authority says the same value. So some item you will find in the balance sheet where both of the authorities agree. Now there are two different more items as well. Two items are where one is a permanent nature. One difference permanent nature. If you are going to compare the carrying amount and tax base of any asset, of any liability in the balance sheet, you will find some item that will have a difference of permanent nature, like goodwill. Tax authorities don't accept the goodwill as an asset. Like in the same way, customer list, in the same way, some sort of patent. These are the basically your intangible assets, specifically goodwill. Goodwill always generate the permanent differences. Then you will find a temporal differences. Some items are generating the temporal differences. These are very common items. So the items that are generated, so we can say on an overall basis in the balance sheet, we can find three different types of items. The differences, no differences, permanent differences, and that create temporary differences. And the item that create primary differences, IAS 12 says you need to book the deferred tax. What is the criteria for the IAS 12? IAS 12 says you need to look in, is this asset or is this liability? IAS 12 says if your carrying amount of the asset is greater than the tax base, carrying amount of the asset is greater than the tax base, then you need to book the deferred tax liability. What is the reason for this? Suppose if an asset is there, assuming plant and machinery, carrying amount is 1000, tax base is 750. This 1000 you need to be in the future, you will be getting more cash flows, more benefits, you will be liable to pay more tax. So this is the reason we need to book the deferred tax liability. In the same way, if you are getting lesser cash, if the carrying amount of the asset is less than the tax paid, in the future we will be getting lesser tax, lesser benefits, then we need to book as a basically, it will not be deferred tax liability, it will be deferred tax asset. So if we are looking liabilities, IAS 12 says you need to look into the liabilities as well. If we are looking into the liabilities, then in this situation, my carrying amount, if carrying amount is greater than the tax base, we need to book a deferred tax liability and vice versa. And we have already discussed in our previous webinar. So I'm just quickly going through the reason, you know the reason. Now here I have made the comparison. This comparison is very important. One, why we are discussing in the language of very layman that you need to compare the accounting profit versus taxable profits. Then you need to assess what the IAS 12 says. Just look into this example. On 1st Jan, companies that bought new machinery of 1 million. Then depreciable allocation pattern. Accounting says you need to depreciate it over the period of 10 years, but tax authorities say over the period of 5 years. Initial recognition of the machinery. We know this as per the IAS 12, initial recognition of the assets and liabilities, it will not lead any differences, so it will not lead any deferred tax, because whenever you are buying any machinery, any plant or any asset you are booking in your books, at that time, the base is same. If you are buying any machinery of assuming 1 million, tax authorities and accounting authority, they are asking, yes, the base is same, and both of the authorities agree on that value. So once this asset was recognized, initial recognition, this asset has not generated any temporary differences, and my carrying amount and tax base was same. Now down the line after 1 year, accounting authority says you need to depreciate the asset over 10 years, and they say you need to depreciate the asset over 5 years. So here my depreciation will be 100,000. 1 million divided by 10, 100,000. Here my depreciation will be 1 million divided by 5. It will be 200,000. So here my carrying amount will be cost. Cost is the 1 million less depreciation, 900,000. Here my tax base will be 800,000. The temporary difference is 100,000. If I am multiplying this temporary difference 100,000, it will lead to deferred tax liability 9%, 9,000 deferred tax liability, because this is the asset. Carrying amount of the asset is greater than tax base. In the future, we will have 100,000 more cash flows. We need to pay extra tax on this 100,000. So my deferred tax liability is 9,000. Now just look into this from the penal point of view, in the language of very layman. Okay, so accounting says 1 million, tax 1 million, there is no difference. COGS, there is no difference. GP is same. The item major difference is depreciation. As per the accounting policy, depreciation is 100,000. As per the tax principle, depreciation is 200,000. So profit before tax here, this is 300,000. Here the profit before tax is 200,000. So what is my tax? 300,000 into 9%, 27,000. Here the tax is 200,000 into 9%, 18,000. So as today, we are paying tax 18,000. That would have been, as per the accounting principle, 27,000. But as per the tax principle, this tax is 18,000. Means we are paying lesser tax today of 9,000 that we need to pay in the future. That is my deferred tax liability. So you can check synchronize the principle. What IAS 12 says, you need to compare the accounting base versus the tax base. Then you need to apply, okay, is this deferred tax asset or deferred tax liability based upon the temporary differences, permanent differences, whatever is the case. The same thing we'll discuss in the very beginning, that if your taxable profits are higher today, you need to pay more tax today. And ultimately, these differences are emerging from the balance sheet. The items that are reflecting from the balance, they're reflecting in the balance sheet. All these differences are reflecting or arising from the basically balance sheet. So I believe everyone is clear on this. Now deferred tax asset. Now we have decided in two situations deferred tax can arise based upon the temporary difference, where the carrying amount of the asset is less than the tax liability, and second possibility is where the carrying amount of the liability is greater than the tax base. There are two where there will be, here we have established there is one possibility, here it will arise a deferred tax asset where the carrying amount is less than the tax base of the asset, or in case of liability where the carrying amount of the liability is greater than the tax base, it will lead to deferred tax asset. So these deferred tax, this is the temporary difference deferred tax. IAS 12 says there are two more ways as well where the deferred tax can arise. That's why they are asking if your current period losses or your current period unused tax credit, these losses, these tax credit can be carried forward, and in the future due to these tax credit, due to these losses, you will be liable to pay lesser tax. Since you will be liable to pay lesser tax in the future, you will have some sort of tax benefits in the future, so you need to book the deferred tax asset today. So these are the three different situations as per IAS 12, 1, 2, and this is the third scenario where you need to book the deferred tax asset. But before the booking a deferred tax asset, this is a requirement of IAS 12 that you need to make sure that in the future you will have a taxable profits. Against this, you will be able to adjust these losses. Then you need to book the deferred tax asset. Otherwise, you should not book the deferred tax assets. These are the few examples: retirement benefits, accumulated depreciation, cost of inventories, NRV, research costs, income is deferred. You can go through this in description is there. So I'm quickly going through this: liability, fair value, intra-group. These are the few examples. I just focus basically business prepaid rent, advance rent. This is the advance rent. Business receive. If business receive advance rent, this is your liability. The carrying amount of the liability is greater than the tax base. It will be a deductible temporary. It will not be a taxable temporary difference. It will be deductible temporary difference. Once it will be deductible temporary difference, it will lead to deferred tax asset. In the same way, this is the provision. Again, liability, you have booked a provision based upon the historic record, 1 million to expecting 5%, basically warranty, historical cost, whatever is the cost you are booking provision. This is a 50,000. This is here in this situation, provision you have booked a 50,000. 50,000 is the provision, is a carrying amount of the liability. This is tax base. Again, it will be deductible temporary difference. It will be a deferred tax asset. Third category, these are the tax losses of 100,000. These are the tax losses of 100,000. If these are the tax losses, we have already agreed these tax losses of 100,000 will give us a benefit in the future. So once this will give us a benefits in the future, it will reduce my tax payable. So we need to book the deferred tax asset today. You can look into this. Deductible loss was 100,000. The tax rate applicable to the company is 9%. As a result, the company has tax of 900,000. In the year two, company generated a taxable income on 150,000. On 150,000 into 9%, then it will be 13500. Your previous period tax benefit you need to claim is 9,000, and then you will be liable to pay net 4500. It means due to the deductible tax deductible loss, you will be liable to pay lesser tax in the future. Now discussing the deferred tax liabilities. Deferred tax liability is what the law standard requires basically. Standard requires in case deferred tax liability. Now we have already established there are two reasons due to deferred tax liability. There are temporary differences, and these temporary taxable temporary differences, these taxable temporary differences will lead to deferred tax liability. And taxable temporary differences arising where the carrying amount, we have already discussed here. There are two situations where taxable temporary differences arises, where the carrying amount of the asset is greater than the tax base, or carrying amount of the liability is less than the tax base. In this situation, it will lead to taxable temporary difference, and it will lead to deferred tax liability. So the standard requires whenever there is a temporary difference, this is exactly I had taken the wording of the IAS 12. You need to book the deferred tax liability. When you need to book the deferred tax liability, when there are taxable temporary differences. So IAS 12 says you need to book the deferred tax liability whenever there are taxable temporary differences, but these temporary differences doesn't align from the initial recognition of the goodwill. So if you are recognizing the goodwill in the first year and temporary differences arise, then you should not book the deferred tax liability. But if this is a subsequent or other than initial recognition of the goodwill, then you need to book the deferred tax liability. Second, they said you need to book the deferred tax liability based upon the taxable temporary differences, but they say it should not be initial recognition of an asset and liability. So if this is initial recognition of the asset and liability, which is not a business combination. So if these are differences arising on business combination, then you need to book the deferred tax liability. If these are the initial recognition of the asset or liability, and this initial recognition is not a business combination, then you should not book the deferred tax liability because it will not have an impact on the accounting profits and taxable profits. So here my standard says I need to book the deferred tax liability if there are taxable temporary differences, exceptions are there. In the previous slide, we have gone to standard said we need to book the deferred tax assets due to deductible temporary differences, carry forward losses and carry forward tax credits. In the deductible temporary differences, while booking the deferred tax asset, IAS 12 require we must have future taxable profit, then we need to book. Here, IAS 12 says that we cannot book the deferred tax liability on the initial recognition of the goodwill. We cannot book the deferred tax liability on the initial recognition of any asset or any liability other than that initial recognition is due to the business combination. These are the example accrued interest. Accrued interest is there. Accrued interest is my asset carrying amount is 50,000. Tax base is 0. Taxable temporary difference. I need to book a deferred tax liability 4500. So the same thing. This is for the rent in advance. The company has paid rent in advance. Once the company has paid it by the end of the 1 year, 1 year has gone. The company is going to amortize over the period of 3 years. Tax authorities say you have paid the cash now, you can claim 100% as your expense. So for tax purposes, tax base will be 0. For the accounting authorities, after the 1 year, the remaining carrying amount will be 80,000. Again, it will lead to deferred tax liability of 3600. There is a possibility that deferred tax liability arises due to the fair value increase in fair value of the asset as well. Like I've given you example, assuming the value of the asset was 1.4 million, but they have increased in fair value. The fair value has gone up in the accounting books. The carrying amount of the asset has been increased to 1.5 million. This is the tax base. This is fair value. After the increase in fair value, this is a carrying amount of the asset. This is a taxable temporary difference, and it will lead to deferred tax liability. In the same way, if there is a revaluation, in case of revaluation, carrying amount of the asset will be higher than the tax base, it will lead to deferred tax liability as well. Goodwill. I will take your time on the goodwill. Goodwill, as we discussed, we cannot book the deferred tax liability on the initial recognition of the goodwill. This has been established because tax authorities don't accept the goodwill as an asset. So they are asking you cannot book the deferred tax liability. This is a permanent nature difference. This is a permanent nature difference. So they are asking you cannot book any deferred tax on it. Now, once they are not allowing us to book any deferred tax on it in the initial recognition, means in the first year of recognition of the goodwill, there is a possibility that in the subsequent period, if we are going to do the impairment testing of the goodwill, there is a possibility that the value of the goodwill will come down. And second thing, they are asking this goodwill pertains to the business. This goodwill pertains to the business, and that goodwill will generate future tax cash flows. Then they said basically this goodwill will generate future tax cash flows. So they said the company is taking benefit of that goodwill. The company is liable to pay tax on that goodwill as well. So I will say for the initial recognition, they are not accepting. In the initial recognition, there is a difference of permanent nature. But for the subsequent year, next year, they are asking you will have future cash flows that will benefit that business. You will be liable to pay more tax because that goodwill will generate more revenue in the future. You will be liable to pay more tax. Since you will be liable to pay more tax in the future, so you need to book the deferred tax liabilities today. So for goodwill, we can conclude that if this is initial recognition of the goodwill, you are not liable to book any deferred tax. But if this is not an initial recognition of the goodwill, you need to book the deferred tax. In the same way, initial recognition of an asset and liability, usually initial recognition of an asset and liability, which is not a business combination, that doesn't generate any temporary differences. So it will not lead to any taxable or any deductible temporary difference. You can go through this example. This is the example that are taken from the IAS 12. Asset cost is 150, carrying amount is 100. Cost is 150, carrying amount is 100. This is being depreciation for tax purpose is 90. Tax rate is 25%. So cumulative tax depreciation. This is my tax depreciation from tax base is 150 less 90. My tax base is 80. Tax base is, sorry, 60. Tax base 150 less 90. Tax base is 60. Carrying amount is 100. So carrying amount less 60. 40 multiplied 20. 10 is my deferred tax asset. This has been given here. Sorry, deferred tax liability. Since carrying amount of the asset is greater than the tax base, the carrying amount is 100. Tax base is 60. Since the carrying amount of the asset is greater than the tax base, we need to book the deferred tax liability. Initial recognition, this is an example of the initial recognition. On the initial recognition, they have not booked the deferred tax. You can go through this. Business combination. In the business combination, we said on the initial recognition of the asset or liability, we are not booking any deferred tax. But if this initial recognition is due to the business combination, then we need to book the deferred tax. Here in this example, again, I have taken this example from the IAS 12. You can go through this example. One company A is acquiring any other company. This is the value of the asset that the company is acquiring. This is the tax base of the this is the tax base of the asset or liability. This is the temporary differences, and these temporary differences arising due to the business combination. So if you can go through the illustration, 135 into 40%, they have booked the deferred tax liability. Now, this was the carrying amount of the asset. You can say this is the carrying amount for accounting purpose 504. This was deferred tax liability. Net amount was 450. They are paying 600,000. It has been given here 600,000. So 150 is the goodwill. On this goodwill, it has been very clearly written here. A recognizes no deferred tax liability on the taxable temporary differences associated with the goodwill in the B's jurisdiction. So on this 150, A has not booked any deferred tax liability, but on the initial recognition of the assets, A has booked the deferred tax liability. So two things have been proven. First, if this is initial recognition of the asset or liability, which is not a business, which is not a business combination, then we need, which is a business combination, then we need to book the deferred tax. We need to book the deferred tax liability. Second, if this is the initial recognition of the goodwill, then we should not book the deferred tax. Both of the things has been proven here. Now coming back to the deferred tax applications and computation, keeping in view the requirement of the UAE law. Now we are very clear what is deferred tax. Why we started with the accounting profit versus taxable profit, what the IAS 12 says, how we have drawn the comparison in between the IAS 12 and in between the normal approach accounting profit versus taxable profits. Then we have gone through in which situation we need to book the deferred tax asset, in which situation we need to book the deferred tax liability. What are the exceptions? What are the conditions to book the deferred tax asset? We have gone through. Now we are very clear that what is the deferred tax? What is the taxable temporary difference, deductible temporary difference, deferred tax asset, deferred tax liabilities. Now coming back to the UAE computation. Now the first question is, for one of the major question in the market, people are asking that do they need to book the deferred tax by closing their financial year 31st December 2023? This is the question. What the people are asking? They are asking that they want to close their financial year, which is 2023. They are standing on 31st December 2023. They are closing their books. And their question is, do they need to book the deferred tax? Now, to prove this, do they need to book the deferred tax or not? We need to go to the requirement of the IAS 12 and we need to go to the requirement of tax law. What IAS 12 says, just for your information, IFRS has already been adopted by the UAE in 2017. What the IAS 12 says, this is the exact wording of the IAS 12. IAS 12 says, deferred tax asset and liabilities shall be measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled. Okay. Based on the tax rates that have been enacted are substantively enacted by the end of the reporting period. If the tax rate has been enacted or substantively enacted, then you need to measure the deferred tax asset or deferred tax liabilities. So if the tax rate, I'm repeating, if the tax rate has been tax rate or tax law, tax rates and tax law, tax rates and tax law, two things, tax rates and tax law. If the tax law have been enacted or substantively enacted by the end of reporting period, then you need to measure the deferred tax. You need to book it or you should not book it. That there are separate criteria for this. You need to measure the deferred tax. So now one thing has been proven that this is the requirement of IAS 12. If the law or tax rate has been acted or substantively acted, we need to measure the deferred tax. Now the question arises, if the law has been enacted by whenever you are standing by 31st December 2023, law and tax rate have been enacted or substantively enacted. For this purpose, you can go through the cabinet decision 116 of 2022. In the cabinet decision 116 of 2022, that was issued on 30th of December 2022, effective from 1st of Feb 2023, enforced within 14 days from date of publication, assuming which is 16th of Feb, because this was effective publication within 14 days. So 16th of Feb 2023 requires that for the paragraph A of clause 3 of the corporate tax law, the portion of taxable income of the taxable person not exceeding 375,000 should be 0%. So law has already been enacted. We know this law has already been enacted. Now the tax rate has been enacted starting from 16th of Jan 2023. They said up to 375,000 you are liable to pay 0% tax. Beyond 375,000 you are liable to pay 9% tax. So both of the conditions have been satisfied. First conditions, tax law and tax rate have been enacted or substantively enacted. First. Second thing, the law has been enacted, yes. Rate has been enacted, yes. Then you need to measure the deferred tax by stand whenever you are closing your books of December 2023. And principally, whenever you are closing any books after this date, because law has been enacted before that, rate has been enacted on this date. So whenever you are closing your books after this date, 16th of Jan 2023, whenever you are closing your books, principally you are liable to book the deferred. You need to measure the deferred tax. You need to book the deferred tax. This is what I have said here as well. Now, computation of deferred tax. Very interesting thing and very debatable topic, hot topic in the market. Everybody is asking, okay, what should be the value of the deferred tax? This is my opinion. I have gone through the law, I have gone through the requirement of IAS 12. I have very good discussion, very healthy discussion with the various people in the market. I have internal discussion with the team as well. And based upon this, we have developed our understanding. And we believe whatever we are thinking, this is very correct. The computation of deferred tax, it depends whether you are in the transitional phase or you are the post-transitional phase. Whenever I'm asking on the transitional phase, assuming your tax period is 1st of Jan 2024. This is your transition. This is your basically tax entry zone. You are entering into a tax zone on 1st of Jan 2024. You are closing your books by the end of 31st December 2023. Once you are closing your books of 2023 and you are entering into a tax zone, this is the transitional phase. You are entering from the non-tax area to the tax zone, from the non-tax zone to the tax zone. Or you can say it's the free zone to the tax zone you are entering. Non-tax era to the tax era you are entering. Once you are entering from the non-tax era to the tax era, there is a transitional phase. For this transitional phase, Article 61 of the law says, Article 61 of the law says that opening balance should be opening balance for tax purposes should be the closing balance of your immediate financial reporting period. So whatever the closing balance of 31st December of 2023, these balances what are reflecting on the balance sheet of 31st December of 2023, whenever you are closing 2023, whatever the balances which are reflecting on the face of the balance sheet of 2023, law says it will become your opening balance for tax purposes. So once you are entering into the tax era, closing balance of 2023 will become your opening balance for tax purposes. Now, second thing, law says these opening balance should be at the market value. These opening balance taken into the consideration at the arm length principle means first of all we need to brought forward only balance sheet items. Profit and loss it will remain in 2023. We will not bring the because these are the for the year item it will remain in 2023. We will bring only 2020 in 2024 only balance sheet item. First thing. Second thing, these item will be on the fair value in the market value. Arm length principle means at the market value. Now, whatever the balances we have brought while entering into the tax era, these are the balance sheet items at the fair market value. This is the requirement of the law. Once this is the requirement of the law, again we need to screen the balance sheet items that has been brought forward. And there is a possibility, again, this is the same thing that we discussed earlier. There is a possibility that there are three different types of item might be will brought forward. One is no difference item that we already discussed, like cash. Second is a permanent difference item like goodwill. Third is a general item that usually generate a temporary differences. Now this goodwill, in this initial recognition, we have already discussed this. This is the initial recognition of the goodwill. We will not book any deferred tax. Principally should not be any initial recognition since we are carry forwarding the balances of 2023 initial recognition principally should not be there. I think each leg should not be there in my presentation. This is one extra leg. The permanent nature, not initial recognition, because we are carrying forward, and once we are carrying forward the balances might be on the face of the balance sheet, there is a goodwill. If on the face of the balance sheet there is a goodwill, and this goodwill create differences of permanent nature. Once this goodwill create differences of permanent nature, and this goodwill is an asset for accounting purposes, which is not recognized by the tax authority, but this asset will generate future tax cash flows. Authorities say you will be liable to pay tax on the future cash flows because this goodwill pertains to the business which is registered in the UAE, and this goodwill bring benefits to the business. This goodwill bring benefits to the business which is registered in the UAE. So you are liable to pay tax on this goodwill. So if we are carrying forward the balances of 2023, we are entering into the tax zone, and there is a goodwill on the face value of the balance sheet. We need to book the deferred tax liability because this goodwill is not an initial recognition of the goodwill. This is not initial recognition, and we need to book the deferred tax liability. This is the first possibility. Okay, second, general items. So whenever we are entering from the non-tax era to the tax era, law requires that we need to carry forward the balances at the market value. Now there is a possibility in the balance sheet, these balances, all the balance sheet items are coming at the fair market value, or these are not coming at the fair market value. If all the items are reflecting on the face of the balance sheet at the fair market value, so the balances in the balance sheet are at the fair market value, and the tax authority is also asking these should be at the fair market value. There will not be any difference in between those two items, so deferred tax will not arise. I'm repeating, if the carry forward balances, it will be at the fair market value as required by the law. And I'm assuming the balances reflecting on the face of the balance sheet, these are already at the fair market value, so deferred tax will not arise. There is a possibility that the balances reflecting on the face of the balance sheet, these are not at the fair market value, and tax authorities say it should be at the fair market value, then the deferred tax will arise. This is the treatment as per law, as per the requirement of IFS for the transitional phase. Now, what is happening in the market? In the market, majority of the business, almost you can say 99%, 999% of the business, they are booking only deferred tax on the goodwill. They are not booking any deferred tax on the general items that are usually creating temporary differences. They believe, okay, what are the value reflecting on the face of the balance sheet? Hard to prove is this a market value or not. For the property, yes, they are going for evaluation. Other than the property, they are not booking any deferred tax. But this is a requirement of the law. Law is very straightforward and clear. If the balances reflecting on the face of the balance sheet are not at the market value and carry forward balances as required by the law or the market value, there is a difference in between this, there should be a deferred tax. So transitional phase is over from my side. I believe everyone will be clear on this. Now coming to the subsequent computation, post transitional phase. Now we have entered in the tax phase, tax zone, entered starting from 1st of Jan 2024 till 31st December 2024. 1 year has gone assuming. Now you are standing by the end of 31st December, by the end of 30, you are standing on 31st December 2024. Or I can say you are standing by the end of 2024. Once you are standing by the end of 2024, now the question is how will you book the deferred tax? Or how the deferred tax will be booked? Will any item will generate deferred tax? It will be deferred tax asset, deferred tax liability. You are standing by the end of 2024. To understand this, will it create any deferred tax, taxable temporary differential? We need to go through the adjustment required. Again, this is the requirement of the law, Article 22. Article 22 says whenever you are converting your accounting balances into the tax balances, you need to make some sort of adjustment, then you arrive at the taxable profit. And the tax will be applicable on the taxable profits. What type of adjustment are required in the accounting profit? I think we have already not discussed in the webinar, but I've written in the article that two approaches to calculate the taxable profit. Direct approach, we can start from the sales, deduct all taxable expenses, arrive at the taxable profit. Second approach is we can take the accounting profit, we can add back the non-cash, and we can make all these adjustments. After making adjustment, we can arrive at the taxable profits. So UE law says we need to follow the indirect approach. We need to take the accounting profit, we need to make the adjustment, and we need to arrive at the taxable profits. So what type of adjustments are there? Unrealized gain and loss adjustment, exempt income adjustment, relief adjustment. These are adjustment we need to make. Then deduction adjustment. Then transaction with related parties, tax relief, transfer of tax loss. These adjustment, incentive, these adjustment we need to make. Once we are making this adjustment, we will be able to arrive on the taxable profits. Now, this adjustment, now the question is by following the IAS 12 approach, carrying amount versus tax base. We are standing by the end of 2024. Once we are by the end of 2024, I need to compare the carrying amount of the asset and liabilities versus the tax base of the asset and liabilities. This clause, unrealized gain and loss, here the law has given us an option that we can apply if my financial statement has been prepared on accrual basis. If my financial statement has been prepared on accrual basis, then we can apply realization basis or accrual basis while making this adjustment. You can go through this. This is exactly Article 20 It should be not 22, it should be 23, I think. It should be 23. For the purpose of calculating taxable income relevant tax period, when the taxable person prepare a financial statement on accrual basis may elect to take into account gain and loss on a realization basis. Now, you are standing by the end of 2024, your financial statement has been prepared on accrual basis. Law gives you an option. You can follow the accrual basis or you can follow the realization basis, cash basis for tax purposes. What will you do? Maximum businesses in the market, they will follow the accrual basis because again, cash basis will be a lot of adjustment unless and until there's a huge impact. You are doing the internal working. After doing the internal working, there will be impact. Might be you are going for the realization basis. Otherwise, majority of the business, they will go for the accrual basis. The financial statement have been prepared on accrual basis and all assets and liabilities, other than the assets and liabilities that are held in the revenue account, all assets and liabilities should be followed the accrual basis. Means accrual fair value of impairment account, like assets under 39, 9, 36, 38, 40, 41, all these assets, all these liabilities, if we are following the accrual basis and tax authorities say you can follow the accrual basis and your balances in the balance sheet are already coming on the accrual basis, so there are very minimal chance of deferred tax here if you are following the accrual basis of accounting. If you are following the accrual basis of accounting and if you are not opting the realization basis for tax purposes, there are very minimal chances of deferred tax. Majority of the item will be out because they are already coming at the accrual basis on the whatever the value reflecting on the face of the balance sheet. This is an accrual basis. The tax authorities ask you have an option. You wanted to go for realization basis or you wanted to continue with the accrual basis. You will continue with the accrual basis, I'm assuming, and there will not be any difference on these items. But they said accrual basis is compulsory for the on the revenue account. They said in asset liability, health and capital at end of tax period, while taking account any unrealized gain and loss arises on the connection with the asset liability revenue account stock revenue account item. So what is the possibility? Assets and liabilities other than revenue account items, they will be for reflecting in the face of the balance on the face of the balance sheet on accrual basis. Authorities are giving you option to continue with the accrual basis. You will continue with this, there will not be any difference. But if you're going for realization basis, then all adjustment will be there. Because once you are going for realization basis, gain and loss adjustment, provision adjustment, depreciation adjustment, all adjustment will start happening. You need to make all those adjustments. It's all up to you. By the end of 2024, when you are preparing the return of 2024, you are sitting in the mid of somewhere in 2025, you wanted to go for the realization basis or you wanted to go for the accrual basis. Impact I've already told you. Now the gain and loss is very clear. So gain and loss, it will have any impact? While calculating a deferred tax liability means if we are following the realization basis, impact will be there. If we are continuing with the accrual basis, there are very minimal chances that it will raise to deferred tax. Exempt income. The law says you need to make one more adjust. Exempt income is a permanent nature difference. This is the income. Accounting authority say this is their income. Tax people say no, this is not your income. This is a permanent nature of difference. It will not generate any deferred tax. Reliefs. This is a requirement of the law. When the requirement of the law that if the transfer of assets or liability within the qualifying group of business restructuring and relief, there are some conditions. If those conditions are being satisfied, then they said you can book the transfer at the book value. For tax purposes, for accounting purposes, they will adjust at the market value because if one entity is selling to other entity, definitely they will not be selling at the book value. They will be charging some premium at the market value. They will be selling at the market value. Law allows you to calculate at the book value. Again, the differences will be assessed and there are chances of deferred tax. In the same way, the deductions, if the deductions are for business purposes and this is allowed by both of the entities, it will not have any impact on the deferred tax. But if the expenditures are not for business purposes, but you have booked in your financials, in your financial you have booked the asset, but authorities are asking this is not the business purposes, it will generate permanent nature of difference. In the same way, interest limitation rule is there. You can go through this like expenditure not incurred for the purpose of taxable person business. If the expenditure is not incurred for taxable person business, means this expenditure has not incurred for business. This is a permanent nature of difference. Authorities, tax authorities will not allow. Accounting will claim it. In the same way, expenditure income driven exempt income. Exempt income. Income itself is creating permanent difference. If they will not consider income for tax purposes, authorities will not allow the related expense of exempt income to be claimed to calculate the taxable profits. So again, it will generate a permanent difference. Losses not connected to carrying a taxable person. If we know this, the carry forward losses, these carry forward losses will generate a deferred tax asset. But if this losses, business A is taking the losses of other business and reducing their taxable profit, nobody will accept it. So again, it will generate permanent nature of differences. Interest limitation rules are there. Accounting for accounting purposes, they will be claiming 100% interest. For tax purposes, they will be claiming 30% of EBITDA. Remaining will be carried forward for the period of 10 years. Again, timing difference will be there. This is a highly complex area. We need to look into this. So again, it will generate a timing difference. This will generate a timing difference. It will generate deferred tax. These areas will not generate deferred tax. Entertainment expenses 50% are allowed and 50% are not allowed. So 50% expenses can generate a deferred tax and 50% will generate only permanent difference. That will not generate deferred tax. Non-deductible expenses, fines, penalties, bribe, dividend, recoverable input tax, donation, grants, gift given to the non-qualifying public entity. These all are not allowable expenses and it will generate permanent differences. So it will not lead to any deferred tax. Tax loss relief in the same way, the tax loss relief, the loss relief is given for tax purposes, accounting purposes, this is not being given. So again, there is a possibility it will generate a deferred tax. Transfer of tax loss, conditions are being satisfied. If the conditions are being satisfied, then this is fine. If these conditions are not being satisfied, then this is a permanent nature difference. Computation, I just take a very small example. WDV is 20 million, then tax base is 20 million. It will not generate tax base 0 because what is the fair market value? They are following the accrual basis. Both authorities are following accrual basis. It will not generate any differences, no deferred tax liability. But permanent differences will arise as we have discussed in our previous slides. Now you're following the realization basis. If you're following the realization basis by standing at the end of 2024, then your financial statement has been prepared on accrual basis. Tax authority, you are opting for the realization basis. Now you need to make all adjustments like gain and loss adjustment, like depreciation adjustment, like accrual adjustment, like amortization adjustment, like any other adjustment that you need to map your numbers as per accrual accounting into the realization basis, and you need to book the again. Whenever you will be doing this, temporary differences will be there, permanent differences will be there. Permanent differences we have already discussed. For the temporary differences, you need to book the deferred tax. Just look into this example that if the written down plant and machines by the end of 20 million, this is WDV, cost is 25 million, less accumulated depreciation 5 million. So WDV accrual basis is 20 million. So if they are following cash basis, machine is 25 million, carrying amount 20 million, tax base 25, asset carrying amount is less than the tax base, will lead to deferred tax asset. This is not taxable, this is deductible temporary differences. Some item will be generating the permanent differences as well. This is over from my side. Thank you very much. I really appreciate it. If you have any question, you can ask. So the critical things was for our today lecture, the important thing was, are we going to book the deferred tax? The answer is yes, because law has been enacted, rate has been decided. This is the IFRS requirement as well. You need to book the deferred tax while calculating the books, while closing the books of 2023. How can you calculate the deferred tax? Because the law says your closing balance will become your opening balance. Once your closing balance will become your opening balance, it will be the market value. Once it will be at the market value, so there will be no difference in between the accrual numbers and cash numbers for cash. There is no difference. Once there is no difference, it will not lead to any deferred tax. So if there is a difference, one difference can be divided due to the basically permanent nature of differences like goodwill. If this goodwill is not an additional recognition, this goodwill is subsequent recognition, and this goodwill will generate future cash flow that the business will take benefit because the goodwill has been generated into that business. So you need to book the deferred tax liability. So on overall say, today, majority of the item will not be leading to deferred tax if these are reflecting on the fair market value in your financial statement, other than goodwill that will lead to deferred tax. And then again, we will have one more session somewhere in 2024 to discuss how to calculate the deferred tax while we are standing by the end of 2024. So, question is okay. There no question. Okay. Answer. Okay. I think Faiza, she is answering. Thank you very much. We cannot see him. Okay. I can see the top of your head. My colleagues see the same. What should we do? I can hear him but cannot see. Now I can. I think might be there's some sort of IT problems. Thank you very much. Thank you very much, guys. Have a lovely day. If you have any question related to a deferred tax, you are facing any difficulty to calculate the deferred tax, you are always most welcome. You can contact us. You can drop us an email. Our number is always there. Email is there. info@presscooper.com. You can give us a call as well. 9714 3391488. Thank you very much and have a lovely evening. Thank you. Bye bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.